This is Sabina Manelli, partner in Baringa, US, talking to you from New York today. The topic for today is to focus on how to take climate change goals and targets that have been set by your institution and translate that into action and change in behaviour. I'm glad to say I'm here today with two of our senior leads from our climate change practice, James Belmont and Dara McDavitt. Both are coming with over 25 years experience in the industry. James from a corporate finance and risk perspective, and Dara from a front office perspective. They're going to give us a balanced view in regard to how this change will impact the first and second lines of defence within your organisation. So I'm super excited about this conversation today and look forward to a balanced conversation from both James and Dara. So with that being said, I'll hand over to James and ask the question, what have you seen from a corporate perspective in regard to how organizations are taking their commitments and translating that into action?
So banks have been subject to external constraints on their balance sheets and their P&Ls for as long as they've existed, associated with leverage. They've had cost income ratio targets. They've had to achieve certain returns on equity, and they will typically use some of three tools to transmit those external constraints through to the businesses. They've got limit frameworks they can use, capital attribution, and transfer pricing.
So limits, right? If I'm somebody in the organisation and you're limiting me, that's a little bit daunting. So explain to me how that works.
So mechanically, this is actually probably the easiest thing to do. It's a slightly lazy option, but there are plenty of limit frameworks within banks. If a bank has already expressed externally a target or a commitment to halve its financed emissions by 2030, for example, then it could simply translate that into internal limits that it applies to the businesses. It is quite crude, but it is mechanically relatively easy to do.
And Dara, if you're sitting in the front office, what would that mean to you? How would that impact you and the way in which the front office would behave?
Well, look, there's a lot of respect for limits. Ultimately, it's a serious offence if you break the limits, so they're effective. In other words, if the organisation is just trying to not have more carbon than X, then obviously allocating limits is an effective tool to do that. I guess from my perspective, what tends to happen is if you think about this whole sphere, it's a new constraint, and the organisation clearly isn't optimal in terms of it's not managing that constraint to date. And we're going to move on going forward. And what tends to happen is you allocate the limits to people who've got the carbon, let's say in this case. So your starting point is not even trying to be the optimal one. It's kind of where you are, which is by definition not the optimal position to be in. So it's fairly blunt as far as I'm concerned, and there's no efficiency to it. There's no sort of trading to it. So as a front office guy, in reality, we arbitrage markets for a living. Let's say we're certainly going to just work out the limits going to be used up reasonably quickly, and we're going to try and fill our boots in the first quarter of the year, regardless of how much money or whether the relative return is higher because I've got carbon or anything else. It's just a question of, well, there's a limit, I may as well use it, and I want to use it before someone else uses it. So that's kind of the response that you get.
Yeah, I mean, James, it sounds like quite a blunt instrument to use. You mentioned two other areas, that capital allocation being another. What would be the benefits of using that approach instead? Yeah,
well, as Dara says, limits are pretty crude, and they don't incentivize efficient use of the balance sheet. They just they probably incentivize inefficient use as people fill their boots, in Dara's language. And so, as a second line guy, I don't much like limits either. When a limit becomes binding, it's sort of an admission that the other incentives you have in your armory have failed. Capital attribution, on the other hand, rations out balance sheets in a way that potentially promotes more efficient use of the constraints. So if you think of a bank already, for example, having constraints on its RWAs and its leverage, they might already be allocating out or attributing out capital in the performance reporting on a basis of some combination of RWAs and leverage. You could extend that and attribute out the capital on the basis of some combination of RWAs, leverage, and financed emissions, or whatever your chosen metric of greenness is. That is definitely an option.
And Dara, from a front office perspective, looking at it from a capital lens, how would that be different, or would there be different behaviours that would create in a positive way?
Well, I think at the sort of the probably at the desk code level, it works insofar as desk codes typically understand, if you communicate to them what good looks like in terms of what a good business looks like and how they should contribute to the division, in terms of what extra return they should expect on let's say carbon or whatever. I think that's a useful tool. It's basically what it's done is it basically takes some of the burden away from the other constraints like leverage and RWA and attributes it to carbon. So ironically, you actually may end up with you may be easy to do trades without carbon, obviously, because you're getting a lower hurdle of return. So that's arguably a positive. And I think that's not an accident. That's deliberate insofar as you want to be allocating capital to, inverted commas, things that are green or at least not brown, and thereby don't have that negative carbon footprint. So from my perspective, you haven't taken money away from me. You've basically just said we expect certain things. If you're going to use carbon, we expect more return. It's logical. So yeah, I mean, I like it. I guess the critical thing is, again, we're starting from an unknown position, therefore using those tools, getting it right, so you actually get the right number at the end in terms of what your finance emissions are, whatever else you're targeting, is a decent exercise to try and optimize.
One of the things that steers me away from a capital attribution, one of the things I don't much like as a second line sort of person in here, is the idea that by attributing a greater share of capital to my sustainability commitments, I've diluted the RWA incentives that I had in place, or the leverage incentives that I had in place. So I'm having to trade off which balance sheet constraints I really transmit to the businesses, because I've only got a fixed amount of capital I can attribute out.
Yeah, and James, because the industry and the regulator hasn't come out yet with clear guidelines in regard to capital allocation and expectations, is there challenges in then implementing that across the organisation, because the mandate doesn't exist, or are there other options for organisations to consider?
Well, the other option is transfer pricing. So banks will already transfer price the funding that they provide when they extend a loan. They transfer price on the basis of the cost of funding the loan, and you could quite conceivably transfer price the cost of carbon, an internal cost of carbon, to your front office. You might aim to do that in a way that was zero sum. So you might set the internal cost of carbon in a way that meant that net your businesses on average had a zero transfer price. But having a transfer pricing mechanism gives you a lever which, if you wanted to, you could pull as hard as you needed in order to create the incentives to steer the balance sheet towards your external commitment. So transfer pricing has some appeal to me from that perspective.
And Dara, what would that mean to the front office? It feels like a very fluid approach, a little bit more less constrained than limits and allocations. How do you see the front office embracing that method?
Well, I mean, if it's a cost, it generally goes down poorly, because obviously it makes you look like you've made less revenue. And I think where that cost is real, in other words, let's say like in CDA, where you've actually got a cost of credit, I can go and take credit without doing any deals. So it's a real thing. It represents expected loss. It's real. Likewise, if my cost of carbon is real, it's something that the bank actually needs to hedge by buying carbon credits or offsets, etc. Then it should absolutely be pushed down onto the desk. The issue is if it isn't real, it's just a lever to steer me towards a certain thing. What then happens is you've effectively created a cost which doesn't reflect the cost of the business. And when you do that, that's actually really impactful, because what you've done is you've changed the way I behave. So there could be situations where the bank's making, let's say, 80 basis points running, and we think that's great. But because the cost of carbon takes away, let's say, 40 basis points of that, I'm going to only see 40, and I've still got risks to this transaction. So the bank thinks it's a good trade relative to the risk because it's making 80, but me as the person who's deciding whether to go ahead with trade or not, I'm only seeing, let's say, 40 basis points of that, and it will therefore change my decision as to whether to do that deal or not. So that's the impact. That's the sort of the major difference between, let's say, a hurdle rate of return and, green RWAs or whatever is effectively just doing the same thing. You have effectively taken the ROE and you've turned it into a hurdle rate of return or cost of carbon, if you like. But here we've got a hard cost. It will change my behaviour, and it won't, therefore, I think, get the optimization that you desire.
It sounds to me like there's some great pros and cons to all of the options, and potentially over time a healthy tension that needs to occur, by considering each of them from a corporate perspective versus a frontline perspective. James, is there any experience that you could talk to in regard to what you're seeing at clients as to what way they're looking across these three dimensions or others, whether that be hybrid or a single approach to this?
Yeah, I'd say a couple of things. Firstly, you definitely don't want to do transfer pricing and capital attribution. You'd simply be double counting and creating unnecessary complexity, having both of those incentive mechanisms. But you might quite conceivably have one of those with some limits as a backstop that you hope never to use. The other thing I think is that's going to become clear is banks are making these external commitments right now, many of them before having actually determined internally how they're going to deliver on those decarbonisation commitments. And it would be quite possible, quite unsurprising, if in a few years' time, approaching a commitment, they realise that the external politics or the technology change that is in the real economy just hasn't been sufficient to enable them to get particularly close to their targets, or their front office haven't changed their origination enough to enable the bank to meet its targets. And so I think you'll start to find the emergence of what I would call contingency emissions plans, a bit like a contingency funding plan, where you pre-agree, or a recovery plan where you pre-agree in a certain situation what's the menu of options, of actions that your businesses could potentially take to deliver on those targets. What are the financial trade-offs associated with taking those transactions, and what's the lead time associated with those actions? And having that in your armory up front before it becomes a real live commercial issue, I think is going to be important for banks to enable them to steer through to these targets in the coming years.
Yeah. I mean, that resonates with me as somebody who has a healthy risk paranoia. Having a contingency plan, because the future in this area is unknown, seems like a great idea. Dara, from a front office perspective, recognizing some of this is new change coming down the line, but it's not new to people. Do you see the front office already taking action in this space ahead of some of these frameworks being implemented?
Well, I think that it's really a mixed bag. I think anywhere where you've got a new constraint coming in, you should take a hard, long look at your portfolio of investments and whatever desk, whether it be project finance or trading, and say, well, which of these are the metrics going to change on? Because again, if let's say 200 basis points was a good trade intensely looking to decarbonize, and then suddenly you've got a loan to a long-dated loan to a coal-fired power station, then you can expect that to reprice. If you leave it on the books, fine, you don't take a loss, but then the opportunity cost is that you could have done a new deal if you wanted to a, not that you would, but to a coal-fired power station, let's say, and got a much higher return. So that sort of concept of cleaning the decks, if you're getting ahead of the game, anticipating change, I think is a really powerful one. And likewise, what good looks like is people looking for opportunities to, do I chase after the green? You can imagine everyone rushing to the door to do green financing, for example, in order to be seen to be, adhering to that management action. Obviously, that can drive down returns of those things, which is ultimately what we want, right? We want the cost of financing of things which will change the climate to be lowered. But if you think that's going to become more and more of a constraint, then that price is going to go down and down and down, and you want to do that early. So again, cleaning the decks, anticipating that, and then potentially taking profit later would be, I would say, the intelligent thing to do.
So I suppose a few key takeaways that I took from this conversation: change is coming. In that, it really is now about how to take action. There's a number of ways to do that that will drive different behaviours and outcomes, and organisations have to look at it from a balanced approach perspective, so they get the right outcomes front to back in the organisation. I love James's point in regard to have a contingency plan, that there's something that you can fall back on, and then Dara's closing point there in regard to the front office getting ahead and starting to look at their portfolio now, as opposed to waiting for those actions or constraints to come down the line. I think there's lots more that we can talk on this topic in regards to the detail of how you put processes and technology in place to support this. We won't have time today, but maybe we'll add that to our next slot of the series. With that being said, we'll sign off from this Baringa podcast and close out. Thank you.
Thanks very much, Luna.
Thanks, everyone.